In this video, I'm going to cover GameStop because it is getting pretty exciting overall. I did open up a position about a week to 2 weeks ago. I wish I mentioned it. Sorry about that, guys. But I opened it up once I saw Roaring Kitty's position was about $100 to $200 million type of investment. And the way the volatility was going, I was like, this could go up to the upside potentially. It was a small position though, and I added more to the position again. Relatively small position for the most part though. But because once I heard today that he's streaming again for the past 3-4 years, he hasn't streamed on YouTube. And you can see right about here, last time I checked, there was about 12,000 people waiting, and it's streaming tomorrow around noontime. So combined with that, I added a little bit more small position additionally too, just in case. We'll see what happens. But the stock is shorted about 30%. That is as of May 15, 2024. The reason why I'm saying that video is because the reason why I'm posting this video is because this is self-reported numbers, 30%, which is in extremely shorted territory. Once it's past 20%, considered extremely shorted territory. But the importance of it is I've always had a thesis that there's like a domino effect of just shorted positions, naked shorted positions, and then the contracts options chain. But that was just always a thesis I thought about. But this guy explains it, and he's Thomas Petterfee, Interactive Brokers founder and chairman. And I haven't seen this video for some reason, but it was dated back since the Capitol hearing and all that stuff, or Capitol Hill and all that stuff. But he explains how the system is kind of screwed if everything breaks up to the upside. Now, the reason why I want to play this video and go over it is you could see that from today, I think the circuit breaker broke 4 times or something, and even when the stock wasn't even moving like crazy, the circuit breaker got triggered again. So I'm like, what's going on here? There's obviously more than just 30% against it. And what I mean by more than 30%, let me explain the thesis. So 30% shorted, these are self-reported numbers, could be shorted even more. Plus there's naked shorts, right? Plus there's contracts. So in terms of uncovered calls, what I mean by uncovered calls being sold, let's just say when GameStop was roughly about, $20 a share, and you thought no way in the next 2-3 months is going to go up to $100. This is before Roaring Kitty came back, right? Let's just say. So you start selling these calls to receive the premium. So let's say you get $5 premium for a $100 call, and you don't have the underlying share price of stock to cover that contract if it goes up higher, to sell that share to cover the loss, right? So you end up selling a lot of these, so on and so forth, and then the stock goes up. You have it on a margin count gets called. You have no choice to hold back on it, and they buy the share price at whatever it might be. And sometimes these spikes are dramatic to the upside. And this creates a major domino effect because there's more plays than just shorting the stock, right? And what I mean by more plays than just shorting the stock, the short positions have to cover to buy the share back, right? But other plays, for example, uncovered calls, uncovered contracts, they have to buy the share as well. So it's not just one-side entities that have to buy the share back to cover and close positions. There's other plays out there. And for most of you guys, I'm assuming almost all of you guys, depending on what kind of level you're at, you have to have access to get to these higher levels. Most of you guys are, for example, if you're playing with contracts, options, and all that stuff, you have covered contracts, which is you have the underlying share. If anything goes horrible, your share gets sold, as opposed to the margin, so on and so forth, covering it, right? Now, if you got the higher level access, you could do uncovered calls, so on and so forth, where you don't have the underlining, and that's the problem. This all stacks up. Again, those other additional plays are not reported in this. Now, in the video he mentions, which I never thought about, was the risk factor. The risk factor is the crazy part where if you're opening up short positions, or whoever's opening short positions, they're thinking that the risk is roughly about 30% short positions, so on and so forth. So let's say short shares, about 68.39 million short shares. So they'll probably short, let's say 10 million shares. Well, the problem is at the same time, somebody else could be shorting about, let's say 30 million shares. Your risk that you assessed is incorrect because you're going off old data. And the problem about that is now your risk factor has increased significantly. Plus, this is just one-sided. There's other plays that are not even reported on. They're not even counted in this. So, and they all create a bigger domino effect that they're all ultimately, to cover and close their positions, have to do the exact same thing at the shorted share positions that are what they're doing, which is buy the share back. And they're all on margin accounts, by the way, which will be triggered if the margin account or the holders of the accounts doesn't see that there's a possibility that they could cover based off their margin account limits. So they're triggered to buy the shares back to cover completely automatically by the system. So regardless of what the price is. So that creates a massive mess if you really think about it, where the share price could just fly pretty much up to any limit possible as long as the system covers fully. So it gets very dangerous actually. And then to a point that the share price could fly dramatically. And the thing is though, too, in terms of Roaring Kitty, he's got, like, for example, contracts where he's going to force about, I think how many, I'm not sure, it's in the millions, but it's like, let's say 100 million shares or something like that. I'm not sure. He wants to exercise those shares potentially, which would trigger whoever owns those positions to buy that many shares, right? Because in case, like, let's just say, obviously not all of them are naked shorts or uncovered calls, but if he triggers and exercises enough option contracts where it will dip into that could create a domino effect, like a snowball effect, where the rest of them will have to cover as well. And if they cover, then the price gets dragged higher, which triggers the other ones to cover as well, just based off their margin counts, limits triggers. So there's that. Now I'm going to play the video because he explains it, I don't know necessarily better, but at the same time, he's more higher up level in a way. And I'm not a professional, by the way, so please do own due diligence and research before buying and selling. And again, I do have open positions too, so keep that in mind while you're watching this video as well.
The likes of Robinhood hurt their customers, and whether the likes of Citadel,
but I don't know if I already mentioned this, but this is Thomas Petterfee, Interactive Brokers founder and chairman,
are abusing their power. What do you think is the key focus and the likely outcome?
So what I would like to point out here, that we have come dangerously close to the collapse of the entire system, and the public seems to be completely unaware of that, including Congress and the regulators.
The problem is too, it's true what he's saying, that people are unaware of this situation, because first of all, when it comes to the options chain, a lot of people don't even understand it. Like when I talk to other people, and like unaware completely, even like financial advisors, so on and so forth, just unaware. So because of the system of people uncertainty, you got like Congress making rules. If they're unaware, they don't see the magnitude of the situation fully. So that's an issue.
So let me explain to you that on January 26th, Game had closed at $77 a share. The following day, it closed at $148. The following morning, on January 28th, the stock opened at $355 and traded up to $480. At the same time,
so you can see in a matter of like 3-4 days the significance of how high it jumped. Now, back in the day, though, it was shorted over 100%, which is quite significant, and there wasn't that many outstanding shares versus now. But again, the effects are still possible because, again, 30% shorted, but these are self-reported numbers, plus there's naked shorted positions and option contracts that are out there that trigger the same effect. So they all compile, like, could be compounded together, and at the same time created the same snowball effect.
Game had 50 million registered shares outstanding and a short interest of 70 million shares. In addition, there were about 1.5 million calls, which would call for 150 million shares. If the longs repay their margin loans and exercise the calls, their brokers would have been obligated by the rules as they are today to deliver to them 270 million shares, while by only 50 million shares existed. So when the shorts cannot deliver the shares, the broker representing the longs must, by the rules of the system, go into the market and buy the shares at any price, pushing the price into the thousands.
So this guy, when I was looking at the numbers he was giving, he's correct about the numbers, by the way, and he says thousands. Now, I don't know how he came up with the thousands, though, but if his other numbers are correct, I'm pretty sure he did some kind of decent calculation where the thousands was possible. And, like, for example, we saw short circuit breakers happen multiple times today, and I think that's predominantly to prevent potentially this happening, potentially. And at the same time, that when that whole situation happened in the first meme run, that was, in my opinion, not coincidental. Like, I mean, like, it was definitely triggered to protect the system, because there was no way that happened just by chance off of one broker and so on and so forth. Like, in a way, it was to prevent a full collapse. That's what I'm thinking. And he basically states it.
So as the price goes higher, the shorts default on the brokers. The brokers now must cover themselves.
And that situation for the first meme run was kind of crazy. And it could happen again too as well. But in essence, where let's say 50 million shares are available and they need to cover 270 million shares. Well, what happens is whoever owns those shares, they're deciding when to sell whenever they want to. So the share price will keep climbing until it's a satisfied price where the orders to sell come in now, right? That's one of the biggest problems. So the share price could just keep climbing until people are satisfied to sell. But obviously people could open up more short positions so to fill those orders in a way, but it creates a big mess.
They push the price further up, so the brokers default on the clearing houses, and you end up with a complete mess that is practically impossible to sort out. So that's what almost happened. To avoid this in the future, the SEC needs to immediately call for reporting of short interest on a daily basis, because they are currently only reported twice a month. And I think they should increase margin requirements on shorts by 1% for every percent of short interest. That would solve the problem.
So that's the thing. Because the short information is only reported twice a month, the risk level is not correctly assessed until it's too late potentially. That's the problem about this whole system.
As a matter of fact, most people don't even know what the short interest is, because it's only reported twice every month.
All right, so given all this information, I think tomorrow could go crazy, potentially, because what's happening is it's creating a situation where when Ronan Kidding streams tomorrow at 12 noon, people are going to be buying for anticipation. That alone could hit triggers, like levels, where that could trigger people to cover their positions in terms of shorted positions or contracts, options, naked shorts, so on and so forth. And if it triggers them, it could drive up the share price even higher, where it'll trigger the other holders as well to buy. And we'll probably see, I don't know, maybe the same meme run as the first one, or maybe this is significant where we'll actually go up to 1,000s. Who knows? I will say, in terms of the system, they look like they're trying to be able to anticipate how to contain it in a way. That doesn't necessarily mean it'll hold it down fully, but where it won't be like catastrophic to the upside completely, potentially. Who knows? I just know that the circuit breaker was breaking too many times today, which kind of made no sense somewhat, because I saw the stock a little bit stagnant for the most part, like $1 or $2, and it was still circuit breaker would trigger. I know it's based on volatility a little bit, but at the same time, I didn't see a reason for it to be triggered sometimes, but it is what it is. But again, I'm not a professional, so please do your own due diligence and research before buying and selling. And at the same time, I do have open positions currently for this, so do keep that in mind while you're watching this. Thanks again for watching. Thanks again for following X and YouTube, and I'll see you guys in the next video. Peace.